Hello, investors. Well, there is trouble in the trucking industry, and a player in the environmental industries is likely to fall out as well. Restaurants are still strong. Come on, let's dive in and see what's playing out here. Please don't forget to hit that like and subscribe to this channel. Hit the bell so you don't miss a single episode, and tell all your friends about it so they can join in the conversation. All right, investors, we're diving right in with FedEx, ticker FDX. Their yield is 1.7% on $160.52. And yes, they are in the air transportation industry. If you know about their history, you understand why. They're not qualified for cash flow or earnings, but they are a Div 1. So 17 years of increasing dividends per share, with the exception of 2010, where they were flat, and we were allowed a flat year. Now, it's interesting about the air transportation industry because the only two players that made the list really don't transport people, they transport stuff. So all those other companies, American and Delta and Hawaiian and Southwest and United, they didn't make our list, but FedEx and UPS did. So before we get to UPS, let's take a look at FedEx long term. Looking pretty good here, but got to be a little bit concerned about this flattening going on here, so we got to keep an eye on that. And then here is the year-to-year changes. All right, so UPS, the other air transportation company to make the list, United Parcel Services, their ticker UPS, they are at 3.5%. And that's on $115.83. And that 3.5% should absolutely be filled with gold because it's greater than the 2%, the 2.6% that we use as a benchmark. All right, they're not qualified for cash flow or earnings per share, but they are a Div 1, so 17 years of increasing dividends per share, with the exception of 2017 when they were flat. All right, here's what that looks like on the year-to-year. Now, this is pretty good. They took a hit here in 09. Everybody took a hit in 09, didn't they? And they've been doing pretty good ever since. Nice upward slope there. Here's the long-term trend. So if you're looking, the year-to-year changes. So if you're looking for an air transportation industry to put into your portfolio, UPS may be the player to look at. All right, we're going to change gears here. Now we're in the trucking company, so it's another type of transportation. Old Dominion ODFL, 0.4% yield on $171.78. They're a cash flow 1, 17 years of increasing cash flow per share, with the exception of this one negative year here in 9. Again, 9, we know about that. And here's what their long-term trend looks like. So they've really picked it up, but then they flattened out again a little bit, so not real excited about Old Dominion here. All right, now Ryder presents a really interesting challenge for us. Ryder Systems, ticker R. Their yield is 4.6%, so that's really attractive. That's on $48.22, so good entry point. But look at this. They are dropping down here to a non-qualified for their cash flow. They used to be a cash flow 1, but if these numbers hold true for 2019, they're going to be not qualified for cash flow. However, if you look at their dividends, they're not qualified as a div player either because they had these flat years here. Now, if you wait until next year and 2003 is replaced with 2004, now you're going to have one flat year. There'll be a Div 1, so now they'll be back in the game, and they have had a pretty good dividend play here for, ever since they got out of those doldrums. So Ryder Systems could be a good player for those of you that are looking to get some sort of transportation industry into your portfolio and you're interested in an income play. Let's take a look at their long-term trend. That's not too bad. The cash flow line is a pretty steady slope up. Earnings, nothing to write home about. It's kind of up, but not huge. And as we talked about, once they started paying their dividend, they started coming up consistently, and they're at 4.6 now. Here's the year-to-year changes. All right, so Ryder presents an interesting challenge for us in the trucking industry, but it's something you might want to think about. Now, also transporting things around is the railroad industry. Of all the railroad players, only Norfolk Southern NSC made our list at 2.1% dividend yield on $177.50. Not qualified for cash flow or earnings, but they are a Div 1, and you can see they had their flat year in 16. That's what that looks like on the long-term trend. Good slope starting here in 15, heading up. So there's something to think about. And here's the year-to-year changes. All right, now we're going to change gears to the restaurant industry. Good solid players in the restaurant world for you. Cracker Barrel, CBRL. Their dividend yield is 3.1%, not too bad, and that's on $172.10. Not qualified for cash flow, but they are an E1 and a Div 1. I'm sure you've all seen Cracker Barrel out there driving along those highways. You see them off to the side. In addition to some down-home country fill-em-up kind of cooking, they also have the little shops when you come in, so you can buy little snacks and sundries and things like that. Here's their long-term trend line, not too bad. And here's the year-to-year changes. So Cracker Barrel, certainly a player for the restaurant world if you're looking for some income out of your restaurant play. Now McDonald's, a good solid player too, MCD. Their yield is 2.2%, and that's on $219.73. But look at this, they're a cash flow 1, earnings 1, Div 0, hitting it on cylinders there. They're doing well. They had a little trouble in 14, but that's okay. They got themselves out of it, and they've been doing well ever since. And let's face it, we all know that McDonald's is more of a real estate company than they are a restaurant company. Here's their long-term trend line. And here's the year-to-year changes. If you're interested in Land's End, there's a little note on how to save 70% there. Sorry about that. All right, Starbucks is our other restaurant player, SBUX. Their yield is 1.7%, and that's on $96.63. They're a cash flow 1 and an E1. They're not qualified for dividends because they didn't pay dividends for quite a while. They didn't start until 2010. But once they started paying dividends, they've been increasing ever since. So Starbucks could be another player for you in the restaurant world. Here's their long-term trend. Not too bad. And here's the year-to-year. All right, so you got 3 good restaurant plays to choose from. Now we're shifting over to industrial services. ABM Industries, their yield is only 1.8% on $39.91. They're qualified as an earnings 1 and a Div 0. There just isn't a whole lot to get excited about here with these folks. Here's their long-term trend, and here is the year-to-year changes. Also in the industrial services, C.H. Robinson, CHRW is their ticker. They're at 2.4%, and that's on $84.63. They're a cash flow 1, not qualified for earnings, and a Div 1. They had some trouble here in 13, as you can see. So again, just really having a hard time getting excited about what's going on with these guys. Here's their long-term trend. You know, overall, that you'd say that if you looked at this from the long-term perspective, that's not a bad slope. But it's flattening out here. Had your negative here. Maybe they just overdid it. And here's the year-to-year change. All right, so still in the industrial services, Cintas, you've probably seen their trucks running around. Again, hard to get excited about this. Their yield is only 0.8% on $266.17. Not qualified for cash flow or earnings. They are a Div 0, but at 0.8%, is that really anything to get excited about? Here's their long-term trend. So you can see they really picked up here in 17. So if you're looking for something other than an earnings play, there might be something to look at here. But for income, it just isn't a whole lot. But maybe for something else. Okay, Expeditors International, EXPD, again, not a big yield, or 1.4% on $71.60. They are a Div 0. They're not qualified for cash flow or earnings. Here is their long-term trend. Okay, that's, for the most part, that's going up with a little bouncing around here. And here's the year-to-year. Rollins Incorporated, ROL, 1.3%. I tell you, the yields in this industry are just nothing to get too excited about. That's on $32.56. They're qualified as a cash flow 0 and an E1, not qualified for dividends, but, oh no, they'll never be qualified because they had this negative year. So even when this early flat year goes away, they're not going to be qualified because we don't allow negative years for their dividends. So they're going to stay on as an E1 and a cash flow 0. Here's what that looks like on the long-term trends. Again, maybe there's something here other than an income play. You're going to have to dig into that, see what you think about it, and the year-to-year changes. Okay, changing gears. Environmental services now. Republic Services, RSG. Well, their yield isn't much either, 1.8%. That's on $90.27. They're qualified as a cash flow 1, not qualified for earnings. They are qualified as a Div 0, but at 1.8%. Who really cares? Here's their long-term trend, and here's the year-to-year. Also in the environmental services industry, a Stericycle, but they are in trouble. SRCR, they do not pay a dividend, and that's on a valid price of $43.70, but they're not qualified for cash flow. They were going to be an E1, but they've run into some problems here. If these numbers hold true, they will come off of our list and go to the used to be for a while. All right, you can see it right here. That is ugly. And here's the year-to-year changes. All right, so still in the environmental services, waste management company, WM, 1.7% on $119.02. They are a cash flow 1 and a Div 0. Again, nothing to get too terribly excited about. Here is the long-term trends for them. And here is the year-to-year changes. Okay, let's get into something else, shall we? Information Services, Alliance Data Systems, ADS. What is it with the low yields on this bunch of companies here? 1.7% on $152.44, not qualified for cash flow. They are a Div 1. Man, this spreadsheet's messed up here. I got to fix this. Sorry about that, folks. They are qualified as an E1. 17 years of increasing earnings per share, with the exception of this one negative year here in 19, and not qualified for dividends. Here's what that looks like on the long-term trend. And here's their year-to-year changes. All right, so last player in the information services, FactSet Research, FDS, still not a fantastic yield, 1.1%. That's on $279.24, but look at this. Cash flow 0 earnings zero, that should say earnings by the way, earnings zero and div zero. They're banging on all cylinders here. This management team knows what they're doing running this company. It's a shame they don't pay more of a dividend, but you're probably not looking at these guys for the dividend. You're considering them in your portfolio for something other than the income play. Here's what that looks like on the long-term trend. Generally a nice smooth upward trend here, and then the slope even got better here in these last couple years. And here are the year-to-year changes. So FactSet, something to think about for portfolios other than income. So let's rack and stack all of them here. You've got the airline industries, you've got United Parcel. If you're thinking about any of the transportation companies, your two big players for consideration are either going to be United Parcel or Ryder Systems. Now recognize that Ryder's got some challenges going on here. This Div 2 could become a Div 1 and they would be qualified. But if that doesn't change, well, that will change next year because those flat years will go away. That one flat year goes away out in its history, so it does become a Div 1. And then this cash flow, that's if those numbers hold for 2019, they will no longer be qualified for cash flow. So Ryder is a potential player, and then a good solid player is UPS at 3.5%, and they're a good strong player. They're going to be in the list for a while here. In the restaurant industry, you got Cracker Barrel at 3.1, and then you got McDonald's and Starbucks. They're not necessarily strong income plays, but they are good solid companies. Could be something of interest for your growth type portfolios. The rest of these players are just not worth getting excited about. I'm having a hard time with it, except FactSet Research, which would be in your portfolio for something other than income, good strong growth potential, so they're doing well. Folks, I look forward to your comments, your feedback. Let me know if you're going to put United Parcel or Ryder into your portfolio, or if you already have them there. Also, what about your restaurant plays? Who do you have in the restaurant stocks? Leave your comments down below. Tell all your friends about us, and we will chat again next week.